Welcome. Today we're going to talk about scenario planning in a post-COVID environment. I've spent over 20 years working in finance and accounting in the higher education and nonprofit sectors. First starting out in audit with KPMG and then moving to outsource CFO services, and then ultimately serving as a chief financial and chief operating officer for an industrial arts school before launching my own consulting business 2 years ago. Through that experience, I led several institutions through critical economic challenges and even saved a few from going under. Today, we're going to focus on the importance of constantly looking toward the future. So certainly, rapid change that was already occurring in the higher ed sector has now been accelerated by COVID. And it's creating an ever-increasing array of challenges to building our businesses and making them sustainable over the long term. These challenges place particular pressure on our business planning cycles and demand that we plan strategically, but also maintain the capability to flex dynamically to manage increasing levels of unpredictability and uncertainty in order to sustain growth or even just our current operations. Traditional budget and planning approaches typically fail to deliver on this truly integrated approach or to build in this resilience or flexibility that we need in this rapidly changing environment. This is certainly a key challenge for the finance function, both in our role leading the business planning and our increasingly important role as a business partner. So first, as an accountant, I can assure you that having timely, accurate, and actionable financial information is the only way you know if you're headed in the right direction. So I want to talk about what I mean by actionable. So first, let's consider the most important ways that we view financial information, generally on a horizon. If I think about the past, these reports tell us what has already happened. They're usually several months old by the time we receive the audit or our 990. And while they provide a significant value in confirming that we have good internal controls and are properly recording financial information, they're not providing us with a glimpse into the future. Most of us use present view financial reports, things like budget or budget to actual review, maybe even a cash flow statement. And again, while they give us some real-time insight into what we're experiencing, they may or may not give us insight into how to take that information and translate it into the future. So when I think about near term or near future, these are things like our forecasts, our cash flow forecasts. It's where we take our budget to actual information and we convert it to what we think our numbers are going to look like at the end of 12 months or by the end of this current fiscal year. And the important difference is that when we spend time focusing on these near-term forecasts, we are then spending less time talking about temporary timing differences. What are the budget to actual variances that we're seeing on a monthly basis that will take care of themselves by year end? So certainly understanding those variances is important because we use them in order to convert our current financial snapshot into the near future and, better yet, into the far future. So as a strategist, perhaps I'm biased, but I prefer to translate every piece of information into the impact on my business 3 years from today. And so this is important when we think about driving decisions for the future. So what's happening right now with my freshman enrollment, and what kind of an impact will that have on the institution 3 years from now? Of course, we can't ignore scenarios. So our projections that show where we're likely to be each of the next 3 years, we would then overlay on top of those various scenarios. What happens if we increase financial aid by 5%? What happens if we have a further decline or an increase in attrition from our fall to spring semester? And of course, it's important to note that depending upon what role you play at the institution, certain information is going to be more relevant to you. So certainly our auditors are going to be very focused on our audits and our 990s, whereas the CEO and the board tend to care more about the far future. And as CFOs, of course, while we have to manage all four of these realms, the near future and the far future become a more important focus for us. And I will tell you that from my experience, organizations that are relying on audits to get accurate financial information are generally reactive. They're struggling with day-to-day cash, and they never really know where the year is going to end. So by focusing on the future, institutions can understand what changes are happening now that could impact the business in the future. And this is what I'm referring to when I say actionable financial data. So in a recession or a pandemic, the ability to model these different scenarios so that we can take action now to change our future or to affect our future in some way becomes critical. How would you use scenarios at your institution? I find the responses are very few institutions use them regularly. Some of them will plan to implement soon, but the vast majority don't have the time or have never really considered the use. So let's dig a little bit deeper into the use of each, and perhaps that will give you insight into the benefits. Certainly, when we look at budget planning, we're very adept at this. Usually, we're looking at a 12-month snapshot, and it's a combination of historical data as well as a little bit of fortune telling. Most of us are also budgeting at a very detailed level by account, by month. And then we spend a lot of time looking at and talking about the variances between what actually happened and what our budgets tell us. So the budgets are not very nimble at all. Conversely, when we look at scenarios, we're looking at a longer snapshot. We're looking usually at 3 years, some institutions 5 years or longer versus the 12 months. And we are then taking our budget, which was potentially our base model, and then we're overlaying new information as that information occurs. We might have multiple different scenarios happening at the same time. So one scenario, we're viewing what happens if I have a 5% decline in my enrollment and a 9% attrition from fall to spring. Another scenario might be looking at what happens if I have a 10% decline in my enrollment and then a 9% attrition. So we're able to take the best combination so that we can understand what's the worst case scenario, what's the best case scenario for each of our institutions. Generally, we're updating this information as new facts and circumstances reach our radar. And we are looking not account by account, but rather by line item and then by year. And so this allows us to be very flexible because it's meant to help us constantly be looking toward the future and thinking about what action can we take now to impact the future. Let's walk through an example. And what is important is I recognize that you're not going to be able to see all of the numbers here, but what is important is that you are able to see that when I put together a base scenario and I look at my net income, I have a lot of numbers that just with my base scenario are negative. They don't necessarily look like a very positive outlook for the institution. And this is using a tool called Scenario. And of course, there are multiple technology tools, and I'll touch upon those briefly. But what we're able to do is we build in multiple different scenarios, different things. Some of these, they may have a direct impact on the other. So if we're going to construct a new building, we're also going to launch a new program. So what happens is we're able to turn on and off these various scenarios, and we can even build them out a little different. So what happens if we launch a new program and we're only planning 50% enrollment in that new program versus what happens if it's 75% enrollment? So we're building out each one of those individual assumptions, and then we're able to turn them on and off. And we can see instantly what happens to our bottom line. Where do all of these negative net income numbers turn positive with these different scenarios? And it allows us to very quickly see, as some of these start to actually unfold in real life events, we're able to modify very quickly and see what's the impact on the bottom line for the institution. Now let's switch gears a little bit and hopefully think about this and what are some of the benefits of using these scenarios. So certainly it can improve the overall performance of our budgets by letting us plan ahead for some of these challenges or opportunities or growth objectives. It also allows us to analyze a number of possible situations and to show how those challenges or opportunities might impact our institution and our ability to achieve the strategic targets. And then, of course, and most importantly, once we're armed with all of those possible situations, we can start to quickly monitor and recognize early signs as an individual scenario is unfolding. And ideally, we have planned for these in advance. We've had conversations with our institutions regarding what happens if we have a decline in enrollment. How are we going to cut $10 million from our budget tomorrow? So it allows us to plant these seeds ahead of time so that when and if scenarios start to unfold, we're then able to move into action quickly because we've already started to have the leadership at our institution think about what actions they might take in response to different scenarios. Of course, there needs to be a relationship between your scenarios and your budget planning. So let's talk about how we go about incorporating these. First, we develop a base case. So it's like all other parts of your budget, right? You start out using the knowledge of your past business performance and the strategic plans that you have for this year and for the future years, and you develop a baseline projection for the next 3 years. And then, of course, you need to understand what are your key business drivers. So, who are your customers and what services do you offer? And so if we stick with higher education, think about our students, and are our students satisfied with their experience? Are there new competitors in the education space? And is your cost structure likely to change, and how? So if we think about the current COVID environment, are our students having a good experience with a hybrid of online and in-person classes? Does that model cause our cost structure to change in any way? And what are those changes? And, certainly we have a lot of new competitors entering the marketplace now as we start to see other businesses offer online credentials and badges. And will those things affect our traditional higher education models over time? As we start to understand these business drivers, it allows us to really have those conversations and think about, well, what kind of scenarios should we be examining? What are the different buckets of assumptions. How does the student's online experience impact the likely attrition from fall to spring semester? Are students likely to enroll for the fall of next year, given the experience that they've had at their high schools in the current year with online learning? So as we start to develop these independent buckets of assumptions, it allows us then to turn them on or turn them off as we start to see new information come in about enrollment, about student satisfaction, etc. Of course, it's important that we're understanding all of these and their relationship to others, right? So when we talked about online learning, does the relationship between online learning delivery have an impact on attrition? And what kind of an impact? And, and when we think about student experience, how are we examining student experience and the impact on attrition? How will it change our cost structure? So it's really thinking about how does one variable impact another variable. Let's walk through a real example. So a client that I was working with right at the time that COVID hit, we had worked through their budget, and then suddenly we're faced with a pandemic and sending students home. And of course, like most of us, we were just panicked thinking about, well, what's going to happen? How much of a decline? Are we going to have to give tuition refunds? What kind of an impact does this have on fall? Are we going to be able to bring students back to campus? Or because of social distancing, are we going to need to have a 50% housing capacity? So we developed 10, but we narrowed it down to 5. We said that in one case, we would likely have a 10% decline in the number of students, and that because of social distancing, we'd be at about 50% housing capacity, because instead of 2 students to 1 room, we'd have to make them into singles. And our assumption was that we'd have all classes in person. And of course, that was our best case scenario. Next case was a 10% decline in the number of students, 50% housing capacity, so same as the best case scenario, but we also said that there's a really good possibility that we would have to deliver half of our semester online. We'd have to send students home or bring them back late, or a combination thereof. And of course, this implies a further decline in our housing revenue, and of course the expenses associated with it. So that's the interplay between the two. Our third scenario was a 15% decline in students with no on-campus housing and no in-person classes for the first semester, which obviously implies yet a further decline in housing revenue as well as expenses, and in tuition revenue because of the decline in the number of students. And we also thought that some students that we'd have a higher attrition rate from fall to spring. Some students would choose not to return for the second semester because that online experience may not have satisfied them for the first semester. And so, we went all the way up through these scenarios, and ultimately at scenario number 5, put us in a position where our doors would likely close. So a 20% decline in students, no on-campus housing revenue, and no in-person classes for the entire year, right? That becomes a really difficult situation to be in. While it's difficult to think about those last 2 scenarios, we needed to be prepared to put a plan into action in case we started to see signs of needing to move in that direction. But we did spend most of our time and energy planning for the 2 most likely scenarios, which were scenarios 1 and 2. And then we did have significant conversations about scenario number 3, because we needed to be able to monitor for signs. So what are the signs that are starting to indicate that we're going to move from scenario 2 into scenario 3? And then what would we do? So we also had a lot of conversations with leadership across campus to help them to start to think about what would this likely look like if you're in a situation where you have these significant decline in the number of students. We all know that the difference between having 25 students in a classroom versus having 20 does not suddenly mean that we can start reducing our faculty load. So it becomes super challenging to start to think about how to consolidate when there's that much of a drop in the number of students, but it still isn't enough of a drop to really have a clear-cut action plan for how will we start to cut expenses. I think the other important thing is, remember, the value to scenario planning is it's multiple years. So obviously, this year has been super critical for all of us, but anything that happened this year is likely to have an impact on us for the next 3 years. So really, this also allowed us to think about, well, anything that we do now, what kind of a longer term impact is this going to have on us for the future? And so there can really be many, many different scenarios. I think it's just important to make sure that we're thinking about, how can we best focus our time, because we knew that we had 10 different scenarios, but honestly, some of them were very sort of similar bottom line or similar outcomes. So we really tried to narrow in and not be exact and just pick kind of reasonable ranges for which scenarios were the most likely to unfold so that we could start to plan for them. We spent most of our time on the 2 most likely scenarios, and then the scenario that was quite possible, we also spent a lot of time talking about. As you can imagine, this has challenges to it. It's not an exact science. Let's start to think about what are some of those challenges that we experienced. I would say that first and foremost, it's important to think about the fact that finance is a lagging indicator. It tallies what's already happened at the institution. So if we really want to create meaningful projections, we need to partner with the entire institution and its leadership to make sure that we understand the risks and potential changes that are on the horizon. When we think about what's happening with enrollment decline, what are the ways that we can support enrollment or other aspects of our business to help meet our revenue and expense targets? So if returning students from fall to spring semester is a critical factor in our scenario planning, certainly our admissions department is going to have the best information on early indicators that will help us plan for that scenario long before students arrive. And certainly if they're showing warning signs, what could we do to help support them in influencing students' decisions to return? It's thinking about ways that we can help support them instead of just simply looking at cutting costs, which I think we traditionally have always been viewed as focusing on first. So we also want to make sure that when we're thinking about scenario planning, that we're listing, both the obvious and some of the unexpected drivers so that we don't end up with any surprises. So when I think about the drivers of the institution, what I always like to think about is making sure that I don't miss any aspect of the institution. So I think about financial performance is the foundation that supports the entire institution. But when we look at the mission and the objectives of the institution, right, those are achieved or not achieved based on our students and how happy our students are, our ability to convert human capital, so our employees, to provide a great experience for our students, and then, of course, our ability to ultimately run the institution and all of the other aspects that are necessary to achieve the mission. When we're doing this, we can never ignore those external factors, right? Like COVID, the economy. Certainly this year we've also had, a lot of other challenges just happening politically. So when we're thinking about scenario planning, it's important that we have a really good holistic view of the institution, what's happening, and what are some of those potential changes that could ultimately impact our numbers, and what can we do to help support the rest of the institution. So the laundry list of challenges is pretty significant, but McKinsey & Company has some really great resources. And in particular, there's one article called Overcoming Obstacles to Effective Scenario Planning that will give some additional insight into some of the more specific actions that you might want to consider. So now let's move on a little bit and talk about tools that can make some of this scenario planning a little easier. So earlier I shared some screenshots with you from Scenario, and they were nice enough to provide me with these screenshots and the ability to use them, because I think what's important is just thinking about the fact that these tools really help us to look at multiple different options within our scenarios very quickly, very dynamically, and we can save all of this information. So if we look at having, 4 different major buckets of changes, it allows us to create each one of these scenarios simply by turning on a couple of these scenarios and leaving the others off. And then we can look at the next scenario and say, well, what happens if I turn this scenario off? What does my bottom line look like? So if you think about some of the challenges that we talked about, what does a 5% enrollment decline versus a 10% versus a 15% enrollment decline look like? What happens if my housing capacity is down to 50%? What happens if it's 50% and I have to close my campus and send all students home for 1 semester? So this allows you to build those independent scenarios in, and then you can turn them on and off as you need them or don't. So a couple of other things that are really important. Certainly most of these planning tools can pull information from your general ledger. So it makes it a very easy starting point for creating your baseline, because you can just simply import data from a budget file. And then when we're looking at trying to really plan for, well, what's the impact on the School of Business versus the School of Engineering? It allows us to really set up those objects or those departments independently. So very similar to the way that we think about our segments in our general ledger. And then, of course, we can create financial statements based on our multiple scenarios so that ultimately we're able to summarize this information in a way that looks familiar to readers and is also meaningful. And then also most of them have some sort of a visual capability, so that we're also then able to download graphs and charts and put them directly into our presentations for the campus community or for the Board of Trustees. And then when we're looking at the scenarios traditional to our general ledger reporting, we have the ability to drill down. So if there's a number that it just doesn't look right to us, we're able to click into that number and to see more detail. So that's the drill down functionality. And of course, the most important one from my perspective is the whole what if. So, what are these different potential scenarios and how are we monitoring each? The other benefit to these tools is I talked a lot about the net income or the profit and loss statement, but they also integrate the balance sheet and cash flow so that you are able to see as you're turning these scenarios on and off, not only the impact on the P&L for the year, but also what's the long-term impact on your cash? Do you have debt covenants that are going to be impacted by some of these decisions? And what are the things that you could do now to ensure that you're able to meet your debt covenants 2 years from now? So again, it's thinking about actionable data. So is this data telling me something in advance that gives me enough time that I can do something about it so that I don't end up running into issues with debt covenants or running into issues with renewing my line of credit or not being able to pay vendors? And so the visualizations I've talked about as well. So great visualizations that really help to convey some complex information for trustees and for our campus community. So I just want to end with just sharing these as kind of the keys to success. Hopefully each of these points has come across in this conversation today. So things like, knowing your business, knowing the institution, how it works, and understanding your students, and how can you be a better partner throughout the institution to help support the goal of bringing students in, keeping students satisfied, delivering a great experience. And of course, being forward thinking. So we talked about the horizon of financial statements. And, I think it's important just to think about, is our finance department set up for success in this area? We certainly need different skills as finance leaders of the future. And so if we have a finance department that's really set up constantly just trying to get, day-to-day invoices paid, how are we able to build in some skill set so that we're able to get more forward-thinking information in a timely and accurate way? And I can't say enough about this one. It's probably the situation that I walk into more often than any other is a situation where an institution is getting regular budget to actual financial statements, but what's happening is there are so many things that are not included. So they don't have a complete snapshot of unrestricted, temporarily restricted, and the complexity of that release from restrictions. So then they're only seeing part of the financial picture. And then at year end, they're surprised by what the numbers do or do not tell them. So I think it's just thinking about, how can we think more about the future and also make sure that we have kind of that complete view of our financial statements. And of course, we're hearing a lot more about this data-driven collaborative decisions. And so certainly, where we have information that's available, data, it gives us a better ability to make timely and informed decisions. And certainly leveraging the technology that we have between our general ledger, between scenario planning tools, helps us to do that. I do think that with scenario planning, you have to think about taking calculated risks. So I also think that this gives us a little bit more comfort in the ability to do that, right? So if you knew that there was a risk of launching a new program and that it might generate, this bottom line or this bottom line, I think at least understanding the ranges of that and understanding how you would plan for each one of those scenarios gives us a better ability as financial leaders to be able to take that calculated risk, because it gives us some boundaries so that we understand how big or how small that risk might be under those different scenarios, and what are the critical activities that we need to stay focused on to make sure that those risks kind of stay within those different boundaries. And, I would say it's most important to also understand past performance is only going to show you part of the picture. And so, if we're not more focused on the future and trying to convert financial data into future actionable data, I think it's going to be really challenging to manage over the next few years as we are faced with a continued likely decline of enrollments. And of course, that additional pressure associated with our tuition charges. I hope that today has planted a seed for you and that there are a couple of areas that maybe come to mind where you might want to focus a little more energy. And so I encourage you to spend just a second and try to jot those down so that when you leave and you go back to your office, that you can really be mindful of those areas. I hope you found this exercise valuable. And so if you would like more information on strategies for developing projections, training, or even help completing your projections, please feel free to reach out to me. My contact information is Rebecca, Rebeka, at futuredfinance.com. And if you are interested in an article related to today's presentation, please email me and I'd be happy to send it to you. Thank you and have a great day.